Good morning, everyone. My name is Craig Allen, and I am the president of the U.S.-China Business Council, and I want to welcome you to this discussion with Bert Keidel. Before we begin, I wanted to make sure that everyone is aware that this event today will be publicly available after the fact via our YouTube channel. While I want to spread the insights from these events widely, we also want to ensure a robust discussion. To find that balance, I would encourage you to submit questions via the Q&A function, which I will then anonymize. Many of you who are longtime USCBC members know that much of our programming is strictly confidential for our member companies, and mostly will remain so. But as part of our efforts to increase public awareness of the trends that are shaping the China economy, we are making our Macro China series available to the public. As we work to make some of this excellent programming public, I encourage you to share it with your friends and colleagues who might not be USCBC members. As always, we welcome your feedback on how we can make USCBC events and programs a better resource for your company and indeed the community. So with these introductory remarks, please allow me to introduce our distinguished speaker today. So Bert Keidel is an adjunct professor at George Washington University, where he teaches a graduate course on China's modern economy. He's published broadly on this subject, including special analysis on China's statistical system, poverty alleviation programs, financial sector, exchange rate controversies, macroeconomic cycles, and prospects for the 21st century. Professor Keidel served in the U.S. Treasury Department as China Desk and Acting Director of the Office of East Asian Nations. He has served in Beijing for 3 years at the World Bank, and previously he has also served as a field supervisor for the United Nations Development Program. He's also had his own company focused on research in China, and he has a BA in Public and International Affairs from Princeton University and a PhD in Economics from Harvard University, and he has served as a postdoctoral fellow in the Japanese Language Economics Facility at the Tokyo National University. So with these introductory remarks, Bert, may I ask you if you would care to make opening remarks?
Well, thank you, Craig, very much for this opportunity and for reading the book with its 60 graphs. And this book is China's Economic Challenge that is just published this March. And it's great to talk about you with it. And I thank all of the rest of you for tuning in. So in the next 15 minutes or so, I want to present some of the major themes of this book. I then look forward to Craig's and the rest of your questions and insights. But our starting point today is a narrower focus and forward-looking. Today's main topic is the likelihood of a new GDP growth surge in China. Now, by a new growth surge, I mean high single-digit growth. Once things settle down, post-COVID, can China really ramp up growth? In this book, I've concluded that indeed it can, and most likely will. And I expect it fairly soon, at least by mid-decade, barring some new and unexpected, catastrophe. How long could such a growth surge continue? Given factors cited in this book, China's Economic Challenge, I'd say maybe another 10 or even 20 years, if not longer. It just seems to me that two key factors, two policy tools, the policy tools themselves and the investment project plans are already in place. There's one main argument behind the book that supports this discussion. So all along for decades, the book maintains there's been an evolving continuity in China's economic strategy. I think this continuity is ongoing. I'm confident that past policies will continue to operate and evolve going forward. This continuity in successful strategies all but ensures that near-term growth will again resemble past growth patterns, although not the overheated booms that pushed up growth in some periods in the past. My book describes key aspects of this continuity. For example, there's been continuity in reform direction. It's very clear market forces continue to strengthen throughout the economy. There's reforms in international commerce and finance. They are ongoing. There's been continuity in long-term strategies like industrial policy or rural modernization. And importantly, there's been continuity in China's practical reactions to surprises, to unexpected events, as in the past. You know, a number of recent developments were totally unexpected. In addition, it seems to me that this policy continuity has stretched over various timeframes. It's clear that the Jiang Zemin and Hu Jintao administrations, their policies and strategies and documents continued through to the Xi Jinping administration, even down to lists of policy items in major documents. We can see continuity over the past 10 years. The Xi Jinping and Li Keqiang approaches and their various adjustments they've had to make, and they've all been quite consistent in the analysis of this book. And just as important, I would argue that this policy continuity goes way back, even back to Deng Xiaoping and Chen Yun. You know, their bedrock principles from the 1980s and early 1990s are reflected now in key policy moves, like the response to Jack Ma. So the major point is that China's approaches to promoting growth in the past, they're still functional, they're available now, and they're likely to still be operating in coming decades. Now, what are these successful approaches? Most fundamentally, they have two main components. First, high investment shares, very high investment shares in GDP. And second, aggressive management of overall national demand. You know, with demand management handled mainly through fiscal interventions. So let me say a few things about each of these. First, China's high investment rate. You know, it's over 40% of GDP. It has been for more than 10 years. This high rate has been crucial for growth in the past, and it will clearly remain crucial for renewed rapid growth going forward. You know, most economies in the world, they can't accomplish high GDP investment rates in GDP. The China's economic challenge describes how China has done it through a gradual cyclical process, raising it over stages in past decades. China's investment rates, they're even higher than Japan's and South Korea's in their miracle growth periods. You know, and economic theory backs this up strongly. The most basic economic growth theories, all of them, make higher investment rates, higher savings rates, which is the same thing, the key to more rapid growth. So looking forward, there's clear continuity in China's current high investment rates. The second key factor is aggressive domestic demand management. I would say it's arguably as, if not more important than high investment rates. So why is sustained strong growth in demand important? You know, without it, for-profit companies won't step up their investment pace. In virtually every economy, the bulk of investment funding comes from enterprise gross retained earnings, not from household savings. For China, 2/3 of investment is from retained earnings. Important question, though, is what sustains strong investment from retained earnings? Well, this sustained investment depends on companies' expected growth in demand for their products. For-profit companies have to be confident there will be markets for future output. Sustaining enterprise profit expectations, that's the job of national macroeconomic demand management. China has sustained overall demand with aggressive counter-cyclical demand policies. If growth slowed too much, fiscal spending got a boost and real interest rates dropped. If inflation surged, fiscal spending growth slowed and real investment rates rose. So for example, when growth slowed excessively in the late 1990s, Premier Zhu Rongji, he implemented a special fiscal stimulus and then it expanded it. And it really helped stimulate recovery in the early 2000s. When growth overheated in 2007, Premier Wen Jiabao tightened spending, raised interest rates, and by late in that year and into 2008, growth had slowed and inflation had receded dramatically. So there's clear continuity even now in this demand management capability. This summer, fiscal stimulus has been steadily strengthened in response to COVID lockdowns. And China still has the wherewithal to, in this way, continue using this demand component that have been so important for past growth success. So when I look at these factors, China's pro-growth institutions and policies, they're available now to ramp up growth again, when conditions are right. Now, what do I mean when conditions are right? Well, at this point, China seems poised for rapid growth. Very importantly, inflation is quite low. This has always been the case in the past, before major demand surges. Thinking of the year 1990 or the year 2000 or late in 2008. So the question is, what's holding it back now? You could say COVID outbreaks are still part of the answer, but there is a longer-term factor. Financial regulatory shortcomings for financing major public investment projects is a major issue. China's key project going forward is its long-awaited new urbanization program that was first announced in 2014. This urban reform program is essential for long-term national productivity. The program will do more than just expand and modernize urban areas. It's going to merge China's rural and urban labor forces. The process is called Tongchou. The result will be a unified future high productivity workforce. And that's an essential modernization requirement for China. So conditions for pumping up national macro demand will be right when Chinese leadership feels comfortable fully launching this urbanization program. Before this could happen, China needed major financial regulatory strengthening. Inadequate financial regulation has been a problem since at least the financial crisis stimulus and post-crisis financial liberalization. Inadequate regulation created risks for major urban public spending program because, of course, risks of financial instability, but more important, perhaps, were risks that financial markets would divert funds intended for the new urbanization program, divert them to less worthy projects. So accelerated urbanization was going to involve substantial infrastructure investments. It would also include greater relaxation of urban citizenship rules and rural to urban migration. So affordable housing will require major innovative and financial arrangements. But the major funding for this program must be able to flow through reliable financial channels. Some Chinese have called the results of financial regulatory shortcomings a waterbed effect, a financial waterbed effect. The waterbed effect was especially obvious following 2008-2010 financial crisis stimulus. Funds intended for public goods investments leaked into various for-profit local schemes. They required major cleanups in the years following the crisis. However, efforts to suppress those flows in many cases only made them sort of pop up somewhere else. For example, in speculative real estate, just like popping up in a waterbed when you push down in one place. So next, efforts to suppress real estate speculation only led to funds popping up somewhere else, like in a stock market bubble that they had, or in capital flight, which is a very serious problem in the middle of the last decade. So throughout this past decade, major regulatory strengthening has been a high priority. This effort has sought to better regulate what's known as the shadow financial system, which combined interbank lending and finance company loans and a whole bunch of new financial instruments that were rolled out. But by 2019, financial data indicated that this shadow finance regulatory effort had been achieved largely. It was successful. And by very early 2020, early January 2020, leading Chinese economists were telling me that major urban reforms were ready to start. But then COVID-19 delayed the whole initiative. So to my mind, and as presented in this book, China's Economic Challenge, this is where we are today. COVID-19 is still creating temporary uncertainties that are important, but inflation is low. China's trade surplus is quite healthy for the present. China still has a very high investment rate, but overall demand enhancement, especially for major urban projects, has been slowed or delayed by what had been pre-COVID concerns over the financial system's capabilities. So in this way, it seems to me likely that with a new, better regulated shadow financial sector, and as policymakers are comfortable that the financial sector can deliver the funding accurately, that once COVID outbreaks become more manageable, a modest strengthening of urban infrastructure and urban housing investment demand is very likely to accelerate overall GDP growth to sustain high single-digit levels, with normal fluctuations, of course, far into the foreseeable future. And there's an important footnote to this scenario regarding the role of export demand. So in the past, exports, they've been crucial for financing technology imports, but China's trade patterns make it clear that China's growth has never been export-led the way Japan's and South Korea's growth has been. Instead, China's growth fluctuations have actually been negatively correlated with US recessions and growth booms. In the past, when the US economy was booming, as in the dot-com boom in the Clinton administration, China had terrible growth slumps. When the US had recessions, whether it's the early 1990s or in the early 2000s, China had major growth surges that sustained healthy growth. So in this sense, China's growth has always been driven by domestic demand. And again, this is not to say that export earnings have not been important. They help pay for major technology as one major factor. But domestic demand has been king. And this is important when we're considering a possible growth surge going forward. China's chances for a growth surge do not depend on export demand. Instead, past experience shows that what matters is fluctuations in domestic demand. So China's really in the driver's seat when it comes to the demand needed for growth acceleration. I have to acknowledge at this point that my book and the book's expectation is different from a large number of very recent reports, op-eds, public talks about China's economic outlook and policy adjustment needs. Needless to say, I have been surprised, if not shocked, to read and hear many of these analyses. And I hope we can perhaps go into that question in the discussion with Craig. Before we go to discussion, however, I'd like to say a few things about other major themes in the book besides its presentation of this outlook scenario. The overall purpose of the book is to present a general understanding of what it takes for an economy like China's to succeed the way China has so far succeeded. What can China teach us about strategies for other poor developing economies? And this is why the book's title and subtitle are China's Economic Challenge, Unconventional Success. I stress in the book that many unconventional aspects of China's strategy and related institutions, they've been critical keys to the more than 40 years of 40-fold growth success. Now, what are some of these aspects? Very quickly, here's a list of a dozen that are analyzed in the book along with some others. First, the dominance of a planning agency that has leadership authority over fiscal, financial, and international trade and investment strategies. That's China's National Development Reform Commission, the NDRC. Number two, a dominant role for a government-owned investment bank. Number three, a central bank that's not independent from the government's executive branch, which allows it to play an accommodating role for critical investments. Number four, the positive contribution, I would say, and the book argues, of what some call a repressed financial system, but which the book calls an enhanced financial system. It contributes to the affordability of public investments. Five is the critical value of managed rather than an open capital account. And this aspect for China is an obvious one in recent years. Number six is the necessity of a managed foreign exchange rate rather than a free-floating exchange rate. Number seven is the positive and ongoing contribution of government-owned enterprises, state-owned enterprises, for avoiding bottlenecks and for sustaining large-scale and technically advanced production capacities. Number eight, an import strategy that emphasizes technology imports rather than consumer good imports. I mean, this clearly contributes to more rapid development. Number nine, the realization that successful poverty reduction in a country like China requires not only rapid growth, which is key, but also an increase in inequality rather than a decrease in inequality. As rapid growth shifts the population center of gravity from rural to urban areas, spreads out the rich and the poor, and you have higher inequality. But all of those groups move past the designated poverty lines. There's 10, the counterintuitive conclusion that true consumption-led growth requires a smaller share of consumption in GDP rather than a larger share. That's so that investment's larger share can generate even more rapid growth, including more rapid growth for consumption. Number 11, the book recognizes that many of China's strategies that are consistent with Friedrich Hayek's 1994 book, The Road to Serfdom, although, of course, not its oversimplified and ideologically biased 1945 rendition in Reader's Digest. Finally, number 12, there's the book's political economic insight that successful efforts to finance rapid growth and significant poverty alleviation will almost of necessity face strong objections from wealthier citizens, almost always in urban areas, objections that can and most likely, almost certainly will spawn violent civil disorder. That disorder will need well-orchestrated public management. So as I just mentioned, these are some of the book's major themes and conclusions. And with that brief introduction behind us, I want to turn the program back to Craig. Thank you all for your patience with my hopefully not overly long monologue. I look forward to Craig's and your questions and disagreements.
Now, one of the real strengths of your book is the analysis of the cycles, the grain cycle, the political cycle, et cetera. And I really enjoyed that. But there are structural issues here, such as total factor productivity, diminishing marginal returns on that fixed capital investment, and I guess declining birth rates and labor inputs. So I'm worried about the longer term, not due to the cyclical, but due to the structural factors. And I'd be grateful for your comments on that, Bert.
Well, I think the structural factors, what you've alluded to rightly, and it's the numbers confirm what you're saying. And particularly the productivity issue. The number that a lot of people note is the incremental capital output ratio. And this has, gone up, which is not a good sign. But if you look at incremental capital output ratios around the globe, and in China's case and in other countries' case, they're not a technical parameter. They're heavily dependent on demand. And so it's quite interesting to watch over say a 20 or 30-year period, a whole range of countries, whenever they have a slowdown in demand, the I-core goes up, and it can go up dramatically. Then when demand picks up, the I-core comes down. So it's not really a sort of a technical measure. It really is a measure of the use of capital. And capital, of course, is a stock, but what it produces is capital services. And so that when demand increases, that capital can be used for a longer period of time in a day. And those capital services can increase without actually increasing the stock of capital. So in a technical sense, the I-core is not a good measure if you're not taking into account the speed of demand, the growth of demand, the strength of demand. And that's what we're just talking about. Why has China, over the last almost 10 years, sort of had a slower output growth? And I maintain it's because they're trying to get the financial system in better shape to handle expansion. And there's been a purposeful slowdown. It's kept inflation very low, but it has enabled them to make, and this is how they've handled the stimulus. They haven't just thrown out a lot of money. They've very carefully spooned it out to small businesses that need it, and actually used fintech to know where the money is needed on parts of consumption and population and so forth. So I think that's a red flag, a false signal of this I-core. I think that it reflects what, in fact, has been a policy of slower growth of demand, weaker demand, but still quite strong. I mean, they've grown at 6% basically in the last almost decade, if not a little higher. And that has been reflected in these measures of productivity. And so I think those are false signals of the underlying productivity of the overall economy. You're muted. There we go.
So very interesting. So you're arguing that the quality of growth is becoming more important than the quantity of growth, and that we'll continue to see quality of growth on a higher base, which is would that be a fair summation?
Yes, I mean, that's because they're still investing heavily in infrastructure. It's good infrastructure. They're waiting until they can finance major projects that are critical for productivity growth. Merging this labor force in the urban areas with the rural informal labor force, that will raise the productivity of this economy enormously over coming decades.
It's true.
I think those are structural changes that they're getting ready to accomplish, but they don't want to waste the money if it's going to leak into other parts of the waterbed.
Yeah, fascinating. It's a Scott Rizal argument in Invisible China, that education of the rural population and integration in the modern economy.
Scott has influenced me a lot to realize the importance of this Tongchou, of this new urbanization program.
Fascinating. Thank you, Bert. Capital controls and the fate of the 2013 plenum reform proposals, including liberalization of the capital account, seem to have, at least in my estimation, kind of not been fulfilled. I'd be grateful for your thoughts on the financial system, and particularly the liberalized capital account.
Right, and the book hits this head on. The third plenum in 2013 said that the market forces would have a commanding or major role, and that this involved also international financial flows, the capital account. And I would maintain that China tried out the reforms that open the capital account. If you go to the 2015, what's called the 8-8 reforms, there was a relaxation of the exchange rate so that it was able to float, and you had really an opening up of permissions to invest in American real estate, to invest in all kinds of American manufacturers. So in the middle of the last decade, there was a lot of capital outflow. In fact, it was a large, from a phrase from several decades ago, a large sucking sound as capital flight really blew out of China. And China at that period had about $4 trillion in exchange reserves. It lost a quarter of that. And China does not print the world's currency. It can't afford that. The United States can. And so I maintain that they tried it. It was a bad idea. And they had to pull back. They had to reinstall capital controls. So my view is that they gave it a good shot. I think they had to realize pretty quickly, within about a year and a half, that this was draining their foreign exchange reserves. That is really a critical cushion to their whole development program, and so they capped it. They stopped it. I would say that the facts of events contradicts the notion that they just never implemented. I think they did, and it didn't work.
So, from an economics perspective, let's say a World Bank perspective, they've ended up in a pretty good place in your view.
Well, yes, except that they have fewer reserves. Now, those have been built back again. And how much reserve does a country need? I mean, the old way to do it would be what share of your imports are reserves. So it's kind of like a checking account. But if you're going to have gradually, and that's what I would argue the Chinese are doing, freer flow of international funds, you need the IMF test, which is what is your foreign exchange reserves as a share of your domestic money supply, because the domestic money supply is ultimately the demand for foreign currency. And China has dropped well below 30%, which, Singapore lost close to, more than 30% during the East Asian financial crisis of its foreign exchange reserves. China can't afford that. It has to be able to maintain the liquidity for all of its operations. And so I think this is something that China has handled, I would say, in a mature and responsible way to cap it. I mean, the United States is serving as the provider of liquidity for the world, and that's one of the reasons that it has a big trade deficit, not because of some exchange rate problems or anything, but China didn't have that capability.
I think, Bert, that many times we compare China to OECD standards, and I think you warn us here very fairly. Perhaps that's not the right thing to do. That we need to look at China in its own terms rather than impose our standards upon them. And one case there that I'd like to probe you on a little bit more is you mentioned the China Development Bank and the importance of its central importance, I believe you say, of its role in China's economic development. Can you expand on that? And is that true today as well? And do you expect that to continue to be true? And this is a subject that not well enough covered in the foreign media. I'm grateful for your thoughts.
Yes, and my starting point here is the assertion that I made a little while ago, that the great failure of market financial systems is that they underfund public goods investments. So around the world, you have an inadequate supply of public investment and maintenance of infrastructure, as well as the expansion of the industry. The private financial sectors don't fund them because they're not profitable unless someone else, the government, is paying for them. So that you then need to say, well, how can you ramp up or enhance investments in public entities? And if you have a dedicated development bank, it can be a partner in financing for projects that may have mixed financing, where the local governments or major municipalities can afford to pay it off over time, but they need some help with lower interest rates from a development bank that is government subsidized. And because this is the role, you could say, of a government, it's the role of a democracy or of a Chinese version of a democracy, is to enhance or to correct the imbalance in the inefficiencies of its financial sector. And the World Bank in the 1990s came out strongly against development banks in a publication called Finance for Development. But it based its work on academic studies that had not gone to peer review, and the book describes this fairly clearly. And the initial study included developed and developing countries, and so it got this conclusion that, well, poor countries the results aren't very good, and they have more development banks. But the peer review, ended up changing the data set, and they did developing countries separately. And you have a kind of a bell curve where there's a median that is sort of unequivocal. There's a median that is neutral about the value of development banks, but half of the bell curve had positive results and half of it had poor results. And so my analysis in the book says it's not important what the median does, it's how do we understand how that part of the curve that succeeded, where the development banks really made a major contribution, what made them a success? And if you want to pick one that's way out on the tail of that bell curve, it's the China Development Bank. So how did the China Development Bank do it? I mean, I met with its president, Chen Yuan, who's Chen Yun's son, a couple of times, and he, with a sort of a twinkle in his eye, said to me, well, here's what we've done, because by then it had one of the best balance sheets in Asia. He said, if we had a municipality that had a project that was in arrears, we stopped new projects to that municipality or to that county. They didn't get any new money until they found a way within their county or their jurisdiction to make sure that that project was back up to speed. And so that meant that their projects all over the country were disciplined by local forces who wanted more money from the development bank. And so it ended up combining its money with these local platform companies. It's New York State uses platform companies to finance its railroads and school dormitories and so forth. Well, China has rolled out that whole process as a response to the financial crisis, really. And the CDB, the China Development Bank, was a major part in partnering in the financing of a lot of those local projects. So I'm a big fan of a well-run development bank. I would say that if you're trying to improve your poor economy's performance, if you don't have a development bank, you're going to be in trouble. And if you do have one, it's got to be well-run. And China is a very good example of a well-run development bank that was critical for success and still is.
Well, I'm grateful, Bert, for your thoughts there. Your book is called China's Economic Challenge and Unconventional Success. And some of these are unconventional views, but they're very well grounded and very well argued. So I thank you for challenging the orthodoxy here. Would suggest more work needs to be done on the China Development Bank. I think it's a fascinating subject. And is it a model for other countries, and how is it a model for other countries would be an interesting piece of work. Can we move on to exchange rates? You're a former Treasury guy, a former World Bank guy. You know this. You've been following this for a number of decades. China's exchange rate intervention to implement a managed float. I'd be grateful for your thoughts on that, and particularly if you have a crystal ball handy, what it might mean for the future of the exchange rate.
All right. Well, I can explain my understanding of the exchange rate. I'm not sure I've got much of a crystal ball in that micro sense. My crystal ball would say I don't expect major changes, and certainly they're now responding actually to the Fed's raising of interest rates, which influences capital outflows down through Hong Kong or through other connector methods. But for me, the exchange rate controversy is kind of a false controversy. The U.S. trade deficit is a function in some significant part of credit growth in the United States, of expanded demand using dollars that really weren't earned from exports, but that were created domestically, either by increasing leverage in the financial sector or just by expansion from the Federal Reserve system during beginning with the financial crisis. So the degree to which and if you look, there are charts in the book that show the rapid growth of consumer credit in the United States under stimulus programs, and some of that goes into the purchasing power for imports. So that means that the United States, by supplying extra capital, extra liquidity, is supplementing what you might call its legitimate purchasing power for imports. And there's a little bit of a model in the book that shows that when you do that, you can't really blame your deficit on other countries. You can't blame it on their exchange rates, for example. And in fact, it's an example of what we might call Dutch disease, a special case of Dutch disease. And Dutch disease, when you have a high foreign exchange earning industry that doesn't employ many people, your exchange rate, your currency appreciates, and other more labor intensive exports are not competitive. So then the proper role is to intervene to keep your currency from appreciating that much. And even some of the more conservative financially backed think tanks in Washington would agree that countries that have a lot of oil offshore or something, then that they need then to make sure that their exchange rate doesn't discriminate unfairly against their more labor intensive export industries. So if you have one source of liquidity in the world pouring out extra liquidity, this puts pressure on other countries for their currencies to appreciate, but it's not because the U.S. has earned foreign exchange and then is spending it again. It's because it's printing it and providing it to the world. The world needs liquidity, so it's actually a very positive development. But it's not fair then to turn around and blame a country like China that has had its exports sucked out of it by this demand that's credit-based, particularly in very strong demand periods. That's credit-based from the United States. So the exchange rate issue in that regard is not the key issue. And another point is that China's exports are heavily in the assembly trade, where you import parts and kits, add a tiny bit of value added, and export them again. Well, that tiny bit of value added is a surplus. But when the volume is large, that surplus becomes, that tiny bit of value added per transaction becomes quite large. But the exchange rate operates on both the import of the parts and kits and on the export of the final product. So it doesn't really have much of a chance to affect that what is a legitimate little value-added surplus. And so when you look at the Chinese trade data, it's divided into two parts, what's called normal trade, which is things mainly produced completely in China. That has a mixed sort of surplus record. If there's really strong demand from the outside, then it has a bit of a surplus. And if demand weakens and there's strong demand domestically, it has a deficit. But the assembly trade side of the data always show a surplus. And so, but that's not connected to the exchange rate. So, I'm quite skeptical of a lot of the brouhaha over the importance of the exchange rate for influencing the balance of trade globally with China and certainly bilaterally with the United States.
Oh, it's fascinating. So you challenge the conventional wisdom here in a very healthy manner. I think that I could say that the conventional wisdom is that China needs to rebalance, that the two prior engines of growth, fixed capital investment and net exports, are slowing down, and that the Chinese consumer is very gloomy right now and unwilling to increase household consumption, which when I last looked, I think last week, I saw at a low of 38% of GDP. Oh, that's a gloomy consumer. That's down quite a few percentage points of GDP. But you challenge that. Does China need to rebalance its growth models, and how to do that?
No, I think that's a false recommendation, and I think there's a bit of a feed into that message from an analysis of trade again, where China has been accused of saving too much and not consuming enough. That also is it's a funny logic, because even if China is saving a lot, the savings are going into investment, a large part of which is imported. So the idea that savings are in China are too high and that's causing a trade deficit, a sort of an unfair Chinese advantage, that just doesn't compute to me. So I think that the rebalancing idea comes from the notion that you just said, that, gosh, wouldn't more consumption as a share of GDP be a stronger, support for growth? And I have to say, I don't see why. Because for one thing, as I mentioned in my opening remarks, if you have a larger share of consumption in GDP, you're going to have a smaller share of GDP in investment. Yes. And over the long term, you're going to grow more slowly if you can, all things, demand management being consistent. And that means that consumption will grow more slowly. So consumption-led growth really needs to be based on rapid consumption growth. And you get that with a high share of investment in GDP, which means a low share of consumption in GDP. So I think there's a kind of a logical misconception here about what promotes healthy growth. There's the kind of sense that, all this investment must be inefficient. There's too much of it. Well, that's something you can look at separately. And this is the I-Corps argument we just had, is productivity of new capital declining? And that, as I mentioned, now that measure really depends heavily on what's happening to demand. And demand is not bad in China right now at all, but it's not 8% growth demand because they don't trust the financial sector. But they will, I think, going forward, and that I-Corps is going to come down. And so that means that investment as a high share in GDP is the best way to promote rapid consumption growth, the best way to have consumption-led growth. So I know it's counterintuitive that having a lower share of consumption in GDP is the best way to have high consumption growth and therefore high GDP growth. But that's not the way, certainly the IMF's Article 4 report that came out in early January, it's all about rebalancing, but it has been for years. And I just don't understand it, I think. And it's not that that it's hard to understand. As I've laid it out, I think it's not viable.
Yeah, I highly recommend that report. I think it's a magnificent piece of analysis, and would invite our listeners to take a look at that. It's on the IMF website. Another area where you challenge the convention, Bert, is with regard to industrial policy and China's innovation policies. In our recent survey, this is a major area of concern for sure, particularly for our industrial or tech companies. But you challenge the conventional thinking, and I'd like to better understand your ideas.
Well, I think the idea is that if you look at China's industrial policy as some sort of something that is not consistent with fair trade or equal playing field and that sort of thing, you can see how it would upset foreigners that feel the competition is getting more heated. If you look at it from a development perspective, there is a whole body of technology and productivity capacity that China has not yet acquired. And so the responsibility of a government in the situation of a poor country like China was several decades ago, and still is much lower in per capita GDP terms than the industrialized world, that your goal is to raise the productivity of your population and its standard of living. And that means acquiring that technology, making it your country able to absorb those high technologies. And you don't just do that with a sort of a laissez-faire, willy-nilly, let's see how it goes. And this has been true for Japan, for South Korea, for the economy of Taiwan, that you and industrial policies are also not unknown in the developed world. And the United States now seems to have one for chips and for other things that it wants to maintain its lead in. And you could argue that the U.S. industrial policy has been, hidden in plain sight in the Defense Department technology, in the Energy Department, in NASA, so that I think it's calling the kettle black to complain about government promotion of new technologies or the acquisition of existing technologies as somehow unfair. From the perspective of competitors, it seems like the government is stepping in to make the competition unfair. But from the responsibility of that government to raise the productivity of its own population and its living standards and to reduce poverty, it's absolutely the right thing to do. And so I think we're in a situation where the perspectives are different and they're understandable, but I think the Chinese government is absolutely right, given the low per capita GDP that it still commands, to promote industries and their technologies and their productivity as much as it can. A very different argument than the ones that many of our members normally would use. I would counter that argument that even on a development basis, and notwithstanding WTO obligations and other commitments that the Chinese government has made, that the industrial policies engender ginormous waste and inefficiencies. The recent removal of the MIIT minister is indicative of money not well spent. Isn't this a problem that, particularly as China goes up the industrial supply chain, that industrial policies are going to pick losers and corruption will abound? That does seem to comport with the facts as at least I currently see them. Well, I think there's sort of a lot to that. But I would say that that's probably a component of all industrial policies around the world. Do they pick winners or losers? And that the only way to really get winners is to have some losers, and that you'll have to live with some not very effective management, but that you have to take the losses with the gains, and that's the only way to do it. And certainly in American industrial development, particularly in DARPA, that defense research programs, or in NASA, I mean, the money that's spent trying to get something right is really ginormous, as you said. And I think in commercial programs meant to help productivity of competitive and for-profit products, you'll have a lot of losses. I mean, for the U.S. program for fracking that was developed in the Energy Department, that took decades. And we don't have a good account of how much was wasted, how many programs or how many particular techniques were tried and were expensive and failed, and they finally found what it took. So there is a cost. But for a poor country, I think the answer is of not doing it is stagnation or near stagnation, and it's just not an option.
Well, thank you, Bert. I really enjoy the challenge and the unconventional thinking and reviewing my own assumptions. And you really help with that. And I'm very grateful to that. As a closing question, let me ask about the effects of the political system on the economic system. I think that during the years of Deng Xiaoping and Zhang and then Hu, there was a warm embrace of market economy and the kind of a loosening of the political system that may have changed, perhaps irrevocably, under the current system. I'd be grateful for your views. From 1980 to 1912, we had really high growth because of changes in the political system to a certain extent. Would you expect that to continue under current circumstances, or should we expect a slowdown of the economy?
Well, I think the rapid growth of the last 40 years that is so remarkable had a lot to do with things that got out of control. I mean, for example, the pandemic of 2003, 2004 caused a lot of stimulus that then was overstimulus. The book goes into some great detail in the 1980s over the excessive funding of purchases from rural areas that then stimulated a lot of rural growth and a lot of money supply growth. The overheating is often a period of very rapid growth. And that overheating, for example, in the early in 1991 and 92, right after Tiananmen, China implemented major grain and cooking oil price reforms that eliminated rationing and allowed market prices to go very high that, increased the productivity of the rural areas and rapid growth in those years. But those are things that are sort of out of control and they need to pull back. That is much better handled now. So we don't see these surges of 14% growth like we saw right before the financial crisis. And so I think that the political component, to me, China, the book describes the leadership components of the Chinese economy and the nature of the government, and it describes the Communist Party as a corporate structure, which I think is exactly what
it's useful.
It's a corporate structure, and that its decision-making process is not a one-man process. And so I think there's a lot of treatment in Western press and media about Xi Jinping does this and Xi Jinping does that. But from my understanding of the way the system works, the Planning Commission, the State Council, and the decisions in the Politburo, there's a lot of information that is fed up through those systems and up about what's going on in the country, what proposals might be useful and productive, and they choose them collectively. And then Xi Jinping becomes the spokesperson. The point, and perhaps also the cheerleader, someone who's helping make critical decisions, but it's clearly not a one-man show, in my view. And so that what we're looking at then is how much has there been a kind of what some writers and speakers recently have called a leftward shift under Xi Jinping, as if Xi Jinping has done this. And the evidence would be, for example, a crackdown on tech that was exemplified by the refusal to allow Jack Ma and his company to list on the New York Stock Exchange. What really happened there was that Jack Ma used his authority and his fame as a finance tech CEO to lobby for less regulation of his financial sector, because his system was expanding finance into areas that weren't well regulated, that could be dicey. And when he stepped out of his role as an executive to begin a political role, I think this is when they reached back to Deng Xiaoping and Chen Yun and those basic principles and said, no, this is not what we are. This is not how we are going to do things. Rather than seeing it as a crimp on the private sector, you could say it's, from their view, a way of making sure the private sector doesn't get out of control, doesn't begin to dominate the economy in ways that affect income distribution or maldistribution. And so that or even the crackdown on the real estate sector, as we've just been discussing. It needs regulation. It needs a government presence that means it doesn't abuse people or lead to instability. So I don't agree with this notion that China's programs in the last decade have really been leftist or have somehow impinged on the private sector. Quite the opposite. And in terms of, for example, foreign exchange, they've opened up what they're calling free trade centers, and there are over 20 of them now. And the book describes how these are actually maybe little Hong Kongs all around the country that allow, to a degree, capital flows in and out that also serve as agglomeration points, but they don't necessarily have the corruption of Hong Kong. So I think there's a lot of creativity, a lot of pro-market efforts, and I just don't see the evidence that there's been a crackdown on the private sector as an important, valuable component, one component of a healthy economy.
Well, Bert, we are at the bottom of the hour, and I want to thank you profoundly for challenging us, for your magnum opus here, China's Economic Challenge and Unconventional Success. It is available on Amazon, and I recommend that our members and our listeners buy it and learn from it. It is extremely well researched, documented by someone who knows and has studied China for decades, and lots of insights.
The Kindle version has colored charts, whereas the printed version doesn't. The Kindle version also has, links. If a table or a chart is mentioned somewhere in the book, there's a link to wherever that table or chart is. Oh. So it's sort of a handier way to read it, but it's not the actual hard copy.
Terrific. Okay, to all of our listeners in China and in America, I'd like to thank you very much. I'd like to thank my friend, Professor Bert Keidel, very much, and wish you all a wonderful day. Thank you for a stimulating and an insightful discussion. Thank you and
Craig,
goodbye.
Very much.
Pleasure. Thanks.